Hello everyone, and welcome to this new video. Today we're going to learn how to invest in ETF and the essential things to know. Have you ever wanted to invest in index funds like the S&P 500 or the Nasdaq, tracking the performance of the US market? Or maybe in European markets like Germany, or even in Asia, like China or India? More generally, have you ever thought about investing in the world's best companies with the MSCI World? Well, today, that's totally possible thanks to ETFs. And in this video, we're going to break down the key things you need to know before jumping into an ETF. Now, let's dive into the purpose of ETFs. ETF stands for Exchange Traded Fund. It's the ideal asset for passive investing. Basically, an ETF is designed to replicate a market performance, like the US market, Asian markets, or major indexes such as the S&P 500 or the Nifty 50. But it doesn't stop there. ETFs can also track specific sectors like AI or even cryptocurrencies like Bitcoin. You can find an ETF for almost any market you want exposure to. For example, here you can see the performance of the S&P 500 over the last 8 years. It's delivered an impressive return. Or take the Nifty 50, which represents the Indian market, another strong performer. You can also invest in specific themes. One example is the Global X Artificial Intelligence and Technology ETF, which follows the AI sector and has delivered strong returns over the past 5 years. Another big advantage of ETFs is that management fees are very low. It's lower than 0.5% per year for more than 70% of ETFs, which is tiny compared to what you'd pay with active investing. Plus, ETFs are listed on stock exchanges continuously during opening hours. It means you can buy or sell an ETF whenever the market is open. Let's now understand how ETF works. The first very important thing is ETF issuers. They are the companies that create and manage ETFs. For example, here in this diagram, we can see the global ETF market share by issuer, and we see that BlackRock dominates the market with almost 30% of the share. It's followed by Vanguard, then by Amundi, State Street, Invesco, and so on. There are hundreds of ETF issuers out there, and you really have to choose them carefully. The top 3 are BlackRock, which is known as iShares for its ETF branch, and they manage more than $4 trillion. Then there's Vanguard, with around $3 trillion under management, and Amundi, with $2.2 trillion. Now, how to find your ETF? There are different tools online. The first one is ETF screener websites, like Morningstar.com, JustETF.com, ETF.com, and so on. Some of them require a subscription to access their full ETF screening tools. You can also find ETF directly on the issuer's websites, for example, iShares.com for BlackRock ETF, Amundi.com for Amundi, Investor.Vanguard.com for Vanguard, and so on. Let's do a simulation. So, for example, if you want to buy an ETF based on the AI sector, just go to the JustETF website to find one that fits. Then, click on the ETF Screener tab, and then on Find ETF. Here, you actually get access to a huge part of all the ETFs available around the world. We search for AI and filter to equity ETFs. Then we get a list of all the ETFs that replicate artificial intelligence indexes. There are a lot of different ETFs offered by various issuers, as we can see. The first one looks promising because it has around $3.8 billion in assets under management, so it could be a solid choice. We click on the X-Trackers Artificial Intelligence and Big Data, and we get all the details. It's issued by DWS, and the ticker is XAIX. So let's simulate that we want to buy this ETF. Then we go to the ETF issuer's website to get the most up-to-date data. In our example, we go to the X-Trackers website by DWS and search for the product, which is XAIX. We find it easily, right here. When we click on it, we get all the key information an investor needs, including all the documents and details like the NAV, asset class, region, and so on. But what really interests us is the portfolio, so we click on that. We can see that 99% of this ETF is invested in equities, and only 0.5% is in cash. There's information on sector allocation. For example, information technology dominates, followed by communication services and other sectors. Then we can explore the regional exposure. 85% is in North America, with smaller allocations in Asia and Europe. Finally, there's a breakdown by country. If we scroll down, we get access to the full list of stocks included in this ETF. The top holding is SAP, a German company, which represents more than 5% of the ETF. It's followed by Microsoft at 4%, Meta, Bank of America, and others. You'll also see names like Nvidia or Apple in the list. There are 5 pages of holdings, and if we click through them, we can find other companies like Nutanix, which has a 0.25% weight, and so on. This gives you clear visibility into where your money is actually being invested. The last step to get exposure to this ETF is to open your brokerage account. So here, I'm using Interactive Brokers, and I'm going to search for XAIX. It shows up here. Let's double-check the name. It's the right one, so I click on it. Here we can see the current price of the ETF, which is around $33, so everything looks good. I can choose the quantity I want to buy. Let's say 300 shares. Then I submit the order, and I transmit it to complete the purchase of this ETF. Let's see what happens under the hood. When you invest your money, for example in XAIX, your money goes to the ETF issuer, which in our example is DWS Xtrackers. This company will manage your money, and as you buy this ETF, it's going to buy for you all the different stocks included in this ETF. It means that 5.16% of your money is going to SAP company, 4.58% to Microsoft, 4.53% to Meta, 4.20% to Bank of America, and so on. The remaining 81% goes to other companies included in the ETF. It's very powerful because by buying just one asset, you own 100 company shares. But there can be some nuances with ETF replication. There are 3 different replication methods: full physical, partial physical, and synthetic. So, for the first one, it's exactly like the example we just saw. The ETF issuer buys all the securities in the index on your behalf. For example, when you buy an S&P 500 ETF, the issuer will buy for you the 500 US stocks, so you actually hold those 500 stocks in your portfolio. With partial physical replication, the ETF issuer uses what's called sampling replication. It means you hold a representative sample of the index. For example, the Russell 2000 includes 2,000 stocks. Your ETF might only hold around 1,500 of them instead of the full 2,000. And finally, the last method is synthetic replication. This is when the ETF issuer doesn't physically buy the stocks. Instead, they use financial contracts called swaps with a financial partner, usually a bank, that pays the same return as the index. Let's take an example with Amundi MSCI Emerging Markets. In fact, this ETF I found on the Amundi website is a very well-known way to get exposure to emerging markets. Here we have an overview. And if we scroll down and click on key information and quotes, we get details like the replication method right here. As we can see, it's an indirect replication. Specifically, it's a swap-based ETF, which allows it to track the performance of the emerging markets index. We can also see that the swap counterparty is the Bank of India, so it's a solid and credible setup. Let's talk about dividends. There are 2 types of dividend payments with ETFs. The first one is accumulating ETFs. That's when the dividends are automatically reinvested in the ETF to benefit from compound interest. You don't pay taxes right away, you only pay when you sell and realize a capital gain. The second one is distributing ETFs. Here, dividends are paid quarterly or annually to investors. In this case, you do pay taxes on the payouts when you receive them. So, it's really up to you. If you prefer compound interest to maximize long-term profits, go for accumulating ETFs. But if you like getting regular income, then distributing ETFs might suit you better. Let's take the iShares Core Dividend Growth ETF as an example. It offers exposure to US stocks that focus on dividend growth. That means all the stocks held in this ETF are known for consistently paying dividends. If we click on Performance and Distributions, we see a table showing total returns over the years, and here, there is a section about distribution dates. As we can see, there are some payout dates listed. For example, the last one was on March 21st, 2025. This suggests that the ETF is probably a distributing one, meaning it pays dividends out to shareholders. If we check under Key Facts, we can confirm that the distribution frequency is quarterly. So that means every quarter, shareholders receive dividend payments. Let's dive into the different ETFs categories. As you understood, ETFs are super powerful because you can invest in pretty much whatever you want. So, let's look at a few main categories. The first one is classic indexes, for example the MSCI World Index, the S&P 500, or even aggregate bond indexes and so on. It's also possible to choose smart beta ETFs. These are indexes that use alternative stock selection or weighting methods, like dividend yield, company size, or volatility. For example, we might give more weight to stocks with high dividends. That's what we call a smart beta strategy. Then we have short ETFs. These track the inverse performance of an index, so you actually make money when the index goes down. And finally, leveraged ETFs. These aim to amplify the daily returns of an index, like giving you 2 times or 3 times the performance. Let's go back to JustETF to explore all the available ETFs. If we click on Equity, we can see that it's possible to invest by region, for example, in Africa, Asia-Pacific, emerging markets, and so on. We can also follow country-specific indexes, as shown here. It's also possible to invest by sector, like agribusiness, energy, insurance, technology, and many others. Then we have the equity strategy section, with options like dividend, equal weight, low volatility, or momentum. This is where you'll find smart beta ETFs, those that follow specific strategies rather than just tracking the market passively. Finally, there's a themes section, where we can invest in areas like artificial intelligence, blockchain, the circular economy, esports, robotics, semiconductors, space exploration. There are tons of investment possibilities. But that's not all. You can also invest in bonds ETFs, on precious metals like gold and silver, commodities, cryptocurrencies, real estate, and money markets. I also want to show you a really interesting feature called currency hedge. For example, if you live in Europe and want to buy an ETF that tracks US stocks, you'll be exposed to dollars. But maybe you want to protect yourself from exchange rate fluctuations between the dollar and the euro. With a hedged ETF, you won't lose purchasing power due to currency movements. And finally, there's the short and leveraged category. For example, you can buy ETFs that replicate the Nasdaq index with 2 times or even 3 times leverage. Or here, you can go short, like -2 times. These are high-risk products, but they give you the opportunity to take more aggressive positions in the market. Let's finish the video with advantages and disadvantages of ETFs. Starting with the advantages. The first one is low management fees because passive index tracking is automated, so fees are usually under 0.5% per year. In fact, all management fees are available on the ETF Issuer website, and as we can see, they are very low and do not exceed 0.5%. Another advantage is the wide range of investment themes. You can invest in different sectors, geographies, strategies, trends, you name it. Also, transparency. All important documents about an ETF are publicly available on the issuer's website. Let's take the Vanguard website as an example. Here we have a list of available ETF. If I select this one, the page for this asset opens, and all the documents are publicly available right here. The same applies to all ETF issuers. And finally, there's very good risk management. ETFs offer diversification, plus rebalancing and updating of ETF components help you follow the market with less effort and less risk. Let me clarify. If we take an ETF that holds all the stocks from a certain index, it means this ETF follows that index exactly. Now, let's say the index manager is checking the conformity of shares in the index, and he realizes that Tesla is no longer compliant due to poor performance. In that case, Tesla will be removed from the index, and automatically from the ETF that tracks it. At the same time, let's say Amazon becomes compliant and qualifies to be included, and can replace Tesla. Then Amazon will be added to the index, and also to the ETF. So, we can see that ETFs are diversified, because they hold many different stocks, which helps spread your risk. Moreover, ETFs are frequently rebalanced and updated so they keep following the market's performance without you needing to do anything. Now, about the disadvantages. The first one is tracking error risk. That means the ETF may not perfectly replicate the performance of its index. For example, if we go to the Xtracker's website and select an ETF, let's say this one, we get all the details about it. If we scroll down, we can see the performance section. Right here, we notice a small gap between the performance of the ETF, labeled as DBAW, and the index it tracks. The index performance is shown with a dotted line, and the ETF's performance is shown with a solid line. As we can see, there's a slight difference between the two. This difference is called the tracking error. It basically means that the return of your ETF might not perfectly match the return of the index it's supposed to follow. The second disadvantage is liquidity risk. As there are thousands of ETFs, some are not very liquid and may be difficult to sell quickly without impacting price. That's what we call slippage. Let's wrap up this class with a quick conclusion. ETFs are the best investments for retail investors because they're passively managed. You don't need to be a finance professional to succeed with them. Secondly, there are hundreds of ETF issuers competing with each other, so you just need to pick the one that suits you best. ETFs allow you to invest in a wide variety of theme, like whole markets or sectors, as we saw. And finally, there's risk mitigation through diversification, rebalancing, and updates of indexes. Alright guys, thanks a lot for joining me in this video and see you soon for the next one on how to choose the right ETF.